Very good morning, friends. So I hope you had a wonderful weekend and you could take out time to make revision on what we have covered so far on financial instruments. So last session, that is yesterday, we covered the aspect of accounting of financial assets. So I'm just going to make a summary chart as I promised you last session itself. But I think before we make a summary chart in terms of accounting of financial assets, covering the aspects of the initial and the subsequent measurement, let's just take a quick recap in the mind in just around 2-3 minutes that what were the aspects we learned in terms of accounting of financial assets. Number one, when you look at the initial measurement of financial assets, it is always at a fair value. We talk of the transaction cost separately. But there are two exceptions in which case the measurement is not done at a fair value, but is done at a transaction value. So the question also comes in that if there is a difference in the transaction value as well as the fair value, then how do you account for the difference in transaction and the fair value, which we are yet to discuss. So there are two aspects immediately what should shoot to your mind when you look at the initial measurement of financial assets, that it is at a fair value. So the moment it is at a fair value, your mind should tell you, what do you do with the transaction? What do you do with the transaction cost? Similarly, the second question which should shoot immediately in the mind is that if you're taking at a fair value, then what do you do with the difference between a transaction value and a fair value? And the third thing which should shoot to the mind is there are exceptions when you do not consider the fair value, but you consider the transaction value, and that is trade receivable as well as a loan recoverable on demand. Three aspects immediately should shoot to your mind when you consider the initial recognition. Then comes the aspect in terms of subsequent measurement, and when it comes to the concept of subsequent measurement, your mind should tell you that yes, I need to apply a three-step model in terms of deciding whether subsequently it will be taken at AC, amortized cost, or at a fair value through other comprehensive income, R or NR, and a fair value through profit and loss account. The three-step model will help you to decide whether we are applying which of the measurement base. The first step focuses in terms of identifying, stepping into the shoes of the issuer and saying that if it is a financial liability for him, it's a debt investment for the holder. If it is equity instrument for the issuer, it's an equity investment for the holder. If it is a compound financial instrument, it becomes a debt investment for the holder. And in which permutation combinations, depending upon the question to the issuer, depending upon the question to the holder, you do the risk assessment, and the crux is if you identify on the basis of the risk assessment, there is no risk, it is AC. If there is a high risk, it is FPTPL. And if you're in between the situation, it is FPTOCI. And remember, debt investments is always with R and equity investment is always with NR. And then we saw the nitty-gritties in terms of when do you apply the concept of EIR, which cases do you capture the fair value changes, when the fair value changes are captured in the tab number 3 of the SOKI, what is the treatment in terms of the accumulated balance in terms of SOKI. So all this we're going to document in the form of a simple little chart, making a mind map at the very start of the session so that it gets deep embedded into our minds that what is to be done in each cases. So in between, I'm also going to ask you questions. If you're able to answer majority of the questions on this chart, then I think your concepts are going super duper. And of course, vice versa. So let's, I think, begin with the chart. Then after that discussion, my focus is going to go on the accounting of financial liabilities with you. Then I think we've got another special agenda. We'll do some practice questions also, of course. As I said, I've got two very interesting questions to give you. The blend of Index 21 with Index 109, the two questions which came in the revisionary test papers. Then we'll discuss about the financial liabilities aspect. And then our focus will turn on to the differences between a transaction value and a fair value. How does the differences get accounted in certain permutations and combination? So I think let's begin the journey with the mind map summary. So I'm just going to create a simple summary chart. And this summary chart is going to be considering the accounting of financial assets. So this is covering the accounting as far as financial assets are concerned. The initial and the subsequent measurement, all the aspects put together. Now, in this particular chart, what I'm going to do, I'm going to consider different categories of financial assets. One is AC, one is FPT OCIR, one is FPT OCINR, and one is the concept of FPTPL. So let's make a total of 5 columns in this chart. So we'll take a column for particulars and then create 4 columns AC, OCIR, OCINR, and FPTPL. So this is the permutation combinations working. So first of all, let me take a column for particulars. Then I am taking a column for amortized cost, fair value through other comprehensive income, which is R, fair value through other comprehensive income, that is NR, and fair value through profit and loss account. So I think let's begin the journey. I'm going to put questions to you as well, because you need to decide if you can answer these questions well, then your concepts are going very good. Let's begin. I'm first of all looking at the concept of equity investments. Do we measure the equity investments at amortized cost? Is the
No,
category
sir.
of AC. That's wonderful indeed. The category of AC does not apply to equity investments. And what about OCIR?
No, sir.
Undoubtedly no. That's very good. Can I say FPT
Yes.
OCINR is
Yes, sir.
applicable and PNL
Yes.
is applicable? And
Yes,
a
sir.
quick question. Which is the default category?
FETPL.
Wonderful indeed. If nothing is given to the contrary, equity investments are taken at FPTPL. So let me just add that element as well. So we can say this is supposed to be the default category.
However, the choice is entity. It is irrevocable choice.
Yes. So if you're given in the question, there is an irrevocable option selected, then it is OCI. Absolutely correct. So this is the default category which is going to apply as far as equity investment is concerned. By the way, another question. Is this equity investment applicable to the related party or is it applicable to the unrelated parties?
Only unrelated party. Related
Very
party is
good. Because we
subsidiary.
decided related party, we're going to apply the concept of Index 27, where you get
27.
the choice of considering cost or a fair value. So this is going to be to the unrelated party. So everything gets squeezed in terms of this particular chart. So I think I'll just make a mention as well that if you're looking at the concept of related party, subsidiary, associate, or a joint venture, then the investment is taken at cost or a fair value. That becomes a choice. By the way, let me also add that if you consider a fair value, then in that particular case, you're back to Index 109. If as per Index 27, you choose a fair value, you come back to Index 109, fair value through P&L or fair value through OCI, though the company has got a choice in terms of cost or a fair value. Okay, that's wonderful indeed. Let's go to the second point. So if I am looking in terms of debt investments, are they taken at AC?
Yes, sir.
Yes, that's absolutely correct. Is OCIR applicable?
Yes, sir.
Yes. Not NR, because NR is only for equity investments. And
Yes.
of course, FPTPL.
Yes, sir.
Default category. What would be the default category in terms of debt investments? There is no default category.
We need to eliminate the mismatch of the accounting.
Yes, but that is only if you want to use a FPTPL. But there
Yes.
is no default category in terms of debt investment because everything is dependent upon the business model, maturity, and all. So there is no default category in this case. So I will just like to put it out here that if you're looking in terms of the default category, there is no default category. So I'll put it across that there is no default category for debt investments. It all depends upon business model. So it depends upon business model. I'm putting it as BM, that is business model. So equity, there is a default category, but debt, there is no default category. Completely depends upon the business model, maturity, sale, or a blended model, whatever. Great. Let's go to the next one. I'm now looking at the initial measurement. I'm now looking at the initial measurement of financial assets at AC. You need to give me the inputs with the concept of TC. So are you going to add TC or not? AC.
FE plus TC.
Very good. It's fair value plus a TC. OCIR.
FE plus TC.
Wonderful indeed. And FPT OCINR.
FE plus TC.
Wonderful indeed. And what about FPTPL?
Only fair value, a transaction cost will be debited to P&L.
Wonderful indeed. I think you're very well prepared for the answers. I like it. Wonderful indeed.
Thank you, sir.
So in this particular case, we can say the TC is immediately expensed. The TC is immediately expense charged to the profit and loss account in this case. Great. Let's now consider the other input as well, and that is number 4. Is the concept of EIR applicable in terms of AC?
Yes, sir.
That's right. And OCIR
Yes, sir.
and OCINR?
No, sir.
Wonderful indeed. And FPTPL?
No, sir.
Great. So let me also remind you and put it in this particular chart that when you're considering EIR, there were 3 situations which will trigger the concept of EIR.
Premium, discount,
Wonderful.
transaction
Wonderful.
cost. Transaction cost.
And the concept of TC. Great. So let me just add that input in this chart as well. So the concept of EIR is going to trigger in 3 circumstances. If you see there is a discount on issue or redemption, maybe there is a premium on issue or redemption, as the case may be, and if there is a transaction cost, this will immediately trigger the need to calculate the effective interest rate. Superb. Let's extend the particular chart now. So these are 4 elements. Let's, I think, add on. So let me continue with more elements in this chart. And we'll put some more elements which we have not discussed as well. But I think that will definitely connect us to some sections to be covered later as well. So AC, OCIR, and OCINR. So this is AC, FPT, OCIR, FPT, OCINR, and FPTPL. And we take the column for particulars. And this is, I guess, my item number 5, I guess. Yes. So next, item number 5, I'm looking at the subsequent measurement. And when I'm looking at the concept of subsequent measurement, my mind is working on the concept of fair value changes to be captured. In AC, do you capture the fair value changes?
No, sir. We are
That's
looking.
right.
Yeah.
And OCI, yes.
Yes, sir.
And it is captured in the OCI. Here also, yes,
Yes.
captured in the OCI. And here also, yes, captured
Yes,
in the
sir.
PN. And another
P&L.
small little inputs at this particular stage. What happens to the balance taken in OCI? It gets accumulated where?
In OCI.
No, OCI it is taken, but it gets accumulated at which place? Soki. And
Soki
that's tab number?
3.
That's right. It is accumulated in statement of changes in equity, and that is accumulated in the tab number 3, which is other comprehensive income section. Great. Let's take some more elements now. Number 6. So now we want to also, though I made a mention in terms of the fair value changes. So let me now also, replicate two things. There is an unrealized gain or loss, which is nothing but a fair value change. And there is a realized gain or loss, which is nothing but a profit on sale. So there are two things which I want to capture. I want to capture the gain or loss, which is supposed to be unrealized in nature, though we have already covered in point 5. But I think I just want to put it as a very explicit input that there is an unrealized gain loss, can I say, which represents a fair value change. And there is a realized gain or loss, which is representing, can I say, the profit or loss on sale. So these are the two elements I think I need to be careful on, because we need to be very clear that in which category, what is the treatment of the unrealized gain loss. Unrealized gain loss means the fair value gain loss, which already is captured in point 5, but to put it explicitly. And there will be a realized gain loss, which is a profit or loss on sale of the financial asset. Let's come to AC. So where do you take the unrealized fair value change?
P&L.
No, 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 no. It is ignored because we do not capture the fair value changes in AC. So unrealized gains, that is fair value changes, are not captured in AC.
It's not applicable.
Yes, it's not applicable, so ignored. What about the realized gain or loss? When you sell, you get a profit or loss on sale. Profit and loss. Because if you're going to sell the investment, though the objective is to hold it till maturity. But I think if you remember, I also gave an example comparing OCI and AC, the profit on sale was equal. So in any case, holding till maturity doesn't mean that I would never sell the investment. If there is a huge credit risk I'm facing, I might sell the investment as well. Correct?
Yes, sir.
Let's now go to OCIR, unrealized gain loss.
It's a transfer to P&L.
No, 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 no. Unrealized is OCI.
OCI.
Because this is nothing but extension of the point number 5. I'm just trying to replicate the point number 5 in a different language. So let me, I think, again clarify. I'm looking at the unrealized gain loss, the fair value changes on the balance sheet date. It's nothing, but this will be OCI, P&L. Then I'm looking at the realized gain or loss, which is on sale. You make a sale of the investment, you get a gain or loss. So let's go to the next one. What about the realized gain or loss?
Okay, sir. OCI?
No, 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 no. It is R. It is P&L. It is P&L. It is only
P&L.
in terms of, I think I remember, you only telling me yesterday that, if there is any unrealized gain in equity investment, it goes in
Sir,
OCI.
yes, sir.
Okay, no worry, no worry. So let's go.
Yes, sir.
relax.
Yes, sir. Right, sir.
Okay, so now tell me unrealized gain loss in terms of OCI NR. Unrealized gain loss in OCI NR.
Yeah, it will
I'm already giving you the
transfer
answer.
to directly to tab number 2.
Why? Okay, I think you're getting a little confused.
Yes, sir,
Let me remind you.
Yes, sir. OCI.
Point number 6 is nothing but point number 5. It's just in a different language. When I say fair value changes, you're not capturing, so ignored. OCI, 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 P&L, P&L. So point number 6, unrealized, is nothing but point 5. Language is different, the concept is same. Then when it comes to realized gain or loss, that is supposed to be you make a sale of the financial asset and you get a profit or loss. Okay, so
Yes,
let's
sir,
go. Okay, let's go now. First of all, to this part. Unrealized gain loss.
P&L.
Yes. And now I think be a little careful on this part. Realized gain loss in OCI NR.
Transfer to tab number 2 directly. We will transfer.
Tab number 2? No, we're going to put this in OCI. You only told me yesterday, and I said, yes, you're right.
Sir, upon sale, then what will happen? That balance will transfer to the reserve and surpluses.
No, that is the accumulated balance which you're talking of. I'm not
Yes,
talking
sir.
of the accumulated balance. Right now, I'm talking only the realized gain or loss on sale, not the accumulated. That's my next point of discussion.
Okay,
Okay,
sir.
let me, I think, just clarify this agenda first of all. If you've got a financial asset, I'm looking at three things. Please hear me very carefully. If I'm looking at a financial asset, I'm looking at three things. At each year end, do you capture the fair value change or not? That's an unrealized gain loss. One. Then I'm looking at if you sell the investment, let's say, for example, financial asset is the investment. If you sell the investment, you get a gain loss which is realized in nature. And then I'm looking at accumulated balance in tab 3. What is the treatment on sales? So three different aspects. Unrealized gain loss at each balance sheet date, realized gain loss in the year of sale, the profit loss on sale arising, and the accumulated balance in SOKI, what is the treatment on sale? So three aspects. Let me first, I think, consolidate this. Unrealized gain loss means the fair value changes which are not considered in AC. In OCI, NR as well as R, it both goes in OCI. In terms of FPTPL, it goes in PNL. Now, coming to the basic rule, if there is a profit or loss on sale of the financial asset, the thumb rule is PNL. Whether it is AC, whether it is OCI-R, whether it is PNL, the only exception is OCI-NR, where the profit or loss on sale goes in the OCI. So even if you sell the investment, the profit loss goes in the other comprehensive income. Then comes the accumulated balance. And what about this? Can I say PNL again? I
Yes,
hope
sir.
I'm clear
P&L.
on the point number 6.
Yes, sir. Now clear, sir. I confused with
Wonderful.
the final transfer.
Okay, no issue. Now that is the seventh point of discussion. Then I'll add another eighth one as well. Now I am looking at the accumulated balance. Which accumulated balance? I'm looking at the accumulated balance, which is in tab number 3 of SOKI. I'm looking at the accumulated balance in the tab number 3 of SOKI. Is there going to be any accumulated balance in terms of AC?
No, sir. It's not applicable.
Wonderful indeed. So it is not applicable. Will there be any accumulated balance in OCI-R?
Yes, sir. It will be there.
And where will you transfer that money?
P&L.
Great. So this is recycling. So can I say it will be transferred to the profit and loss in the year of sale?
Yes,
Will
sir.
there be accumulated balance in terms of OCI NR?
Yes, sir. Definitely. It will
Yes. And
go.
where will it be taken?
It will transfer to tab number 2 directly.
Wonderful indeed. So this is going to be transferred to the tab number 2. So we're going to put this in tab number 2 in terms of reserve and surplus directly, because this is a case of no recycling. And what about the case of profit and loss? Will there be accumulated balance in terms of tab number 3?
No, sir. We are directly charging to P&L.
Yes, so not applicable again. Wonderful indeed. So I think that takes care of the summary chart in terms of various permutation combination. But I'd like to add one more point at this particular stage, which we've not yet discussed, but I think to put it at the appropriate place, since you already know it. So the eighth point is impairment. Whether the concept of impairment is applicable to the concept of AC.
No,
I
sir.
know I'm not given that, but I think since you're all revising things, you know this well. So is the concept of impairment, that is ECL model, expected credit loss model, applicable to AC? I think I'll give the answer, yes. Is it applicable to the OCIR? Yes. Is it applicable to the concept of OCI-NR? No. Is it applicable to the concept of FPTPL? No. I've tried to condense the entire permutation combinations to you, which is condensed version of all the inputs related to the concept of financial assets measurement. I hope, friends, I am pretty clear on the complete picture on financial assets, right?
Right, sir.
Wonderful indeed. So now I think it's time to do some questions with you. As I said, we'll do some interesting input questions. So let me, I think, take on to the questions with you. I'll just probably crop this up and show you the larger picture. So let's have a look at this question. I hope it is clearly visible to you.
Yes, sir. Visible, sir.
Wonderful. So let me just read this question. There is another part to this particular question as well. This is not the end of the question. So there's another part as well. Just a second. Let me just crop this up as well. Is it good to go? Is that visible, I guess?
Not that visible, sir.
Okay, then I'll have to probably show this down. Then maybe we'll duplicate this later. Not an issue. Okay, so I think this should be good to go.
Yes, sir.
Okay, now let me just come back to the question. This is one of the questions in RTP, which is a blend of Index 21 as well as Index 109. So foreign currency along with the concept of financial instruments. Let me read the inputs. It says on 1st April X1, M raised a long-term loan from foreign investors. Now, let me tell you in advance, I have not discussed the concept of financial liability, but at this stage, I assume that you know financial assets, so indirectly we know financial liabilities. When we did the concept of compound financial instruments, we made a financial liability ledger that's nothing but financial liability AC. And trust me, there is no concept in terms of financial liability OCI. Financial liabilities are either taken at AC or they're taken at FPTPL. So in this particular questions, you might find a liability question, you might find an asset question, and I think you know the concept on this. Let's proceed. Now, my question, first of all, if M company raised a long-term loan, is it a liability or is it an asset? Is it a liability or is it an asset? You are raising a long-term loan.
It's a liability, sir.
Absolutely, it's a liability. The investors subscribed for 6 million foreign currency loan notes at par. It incurred an incremental issue cost of 2 lakh foreign currency. What is coming to your mind immediately? There is an incremental issue cost. Can I call this as a TC?
Yes, sir. TC 2 lakhs.
And if I'm following an AC, what does it immediately trigger in the mind? Can I say this will lead to the calculation of the EIR, correct?
Yes, sir. EAR.
Absolutely. Then he says the interest of 6 lakh foreign currency is payable annually on 31st March, starting on 31st March X2, end of the first year. The loan is repayable on 31st March X7 at a premium, at a premium. So what comes into the mind again?
EIR.
Wonderful indeed. So the TC indicates the calculation of EIR and the premium indicates the calculation of the EIR. And then it says the effective annual interest rate is already given to me. So he's already given you the effective interest rate considering a TC and considering that there is a premium on redemption. Then he tells you the appropriate measurement base of the loan is an amortized cost. So he's already told you that this financial liability is going to be measured at AC. So basically what you do in a financial asset, take a mirror image of that, you're going to get the financial liability at amortized cost accounting. Then he says the relevant exchange rates are given. We're given the exchange rate on 1st April X1. And we're also given the exchange rate on the end of the year as well as an average rate of exchange is given. The functional currency of the group is supposed to be Indian rupee. So, which means the transactions are going to be converted in terms of Indian rupee because, as per Indus 21, once you identify the functional currency, all transactions in a currency other than that becomes a foreign currency transaction. So, in this case, INR is the functional currency. What would be the appropriate accounting treatment for the foreign currency loan in the books of M Limited? So M Limited, it is already a financial liability. Calculate the initial measurement amount for the loan, calculate the finance cost for the year, and calculate the closing balance, and also calculate the exchange gain or loss. I hope you're very clear with the concept after reading the question. The question is purely on a financial instruments, financial liability with the concept of a foreign currency Indus 21 blended. And there is no problem. I'll give a very easy technique of handling this particular question. My advice is that when you're doing this kind of a question, you first prepare a financial liability ledger, ignoring the concept that there is any foreign currency. Just make a financial liability absolutely in a usual manner. And then we can do the translation of that ledger at a later stage. So you need to make a total of 2 columns to be on the safe side. So I think let me do that out here itself. So you can see the comparative position. So what I'm going to do in the ledger account, I'm going to create 2 columns. For the amount, I'm going to create a total of 2 columns, 1 column in foreign currency and 1 column for the functional currency. So this is my financial liability ledger. So this is my financial liability ledger, which we are preparing at amortized cost. So we're going to consider first of all the foreign currency. Let me put it as FCY, foreign currency, and this is INR. This is foreign currency and this is INR. So I'm not going to make the 2 columns simultaneously. I will just concentrate on the foreign currency column to begin with. Then we can take care of the Indian rupee later. Let's again pick up the information step by step. So we're given on 1st April, the company has raised a loan for 6 million foreign currency note, and there is a TC to the extent of 2 lakh. Now, with the insights you did on the compound financial instruments, what is the accounting treatment of TC? Add to the financial liability or reduce from the financial liability?
We will directly charge to P&L, sir.
No.
Yeah, we will not reduce it.
We will reduce it. If you remember, in terms of CFI, we decided that the liability element is reduced from the FL and the equity is directly taken in retained earnings, directly charged to equity. So remember, let me also add that point as well. So I'll document this part later, but let's get this very clear. If there is a TC related to CFI, if there is a TC related to financial asset, if there is a TC related to financial liability, I'll document that, but let me just, I think, consolidate that. If you've got a TC related to CFI, we've already seen the treatment. Split the TC between FL as well as equity. The TC related to FL is reduced from the FL, and the TC related to equity is directly taken to equity, charged against SOKI. If it comes to a TC related to financial assets in terms of AC, OCIR, as well as OCINR, it is added to the financial asset.
Yes, sir.
In terms of financial liability, it will be reduced from the TC, just like CFI. But if it is FPTPL, ignored. I hope I'm clear.
Yes, sir. Just opposite to financial asset.
Yes, so treatment of TC for CFI, treatment of TC for FA, treatment of TC for a financial liability. I'll make a chart also later, but this is the treatment. So which means you need to consider the reduction of the TC from that 6 million. 6 million, I guess, is going to be a total of 60 lakhs, I guess.
Yes, sir. 60
so from
lakhs.
that 60 lakhs, you reduce that 2 lakh. So let me first put the entry out here. This is by bank. 60 lakhs is the total money minus the TC. It works out at 58 lakhs. This is the initial recognition, fair value minus the transaction cost. Now, Once you've done this, can I say there is a need to calculate a finance charge at what rate? Is it going to be at the coupon rate or is it going to be at the EIR?
EIR.
That's right. So we are already given in the question the effective interest rate is at the rate of 12%. So let's calculate finance charge at the rate of 12% on this. So 12% on this is 6.96 lakhs. So I think it's pretty simple, except for the concept of the foreign currency. Trust me, we are doing the ledger absolutely in a normal manner. Don't get worried on the part that there is a foreign currency element. You need to make the ledger the usual manner. And now we are also making a payment of interest at the end of the year. So we're also given the inputs out here. It says that interest of 6 lakh foreign currency is payable at the end of each year. So we also going to consider the payment of the 6 lakhs out here. So can I say, since it is AC, we don't need to capture any fair value changes. Let's take the balancing figure as a balance CD. So I think this is going to be 58.96 lakhs, I guess.
Yes, sir. 58.96 lakhs.
So do you see that there is any challenge in terms of making this ledger account? Leave the concept of foreign currency Index 21. We have done nothing. This is the aspect in terms of 109. Now comes the role of translating this in terms of Index 21. So now you need to choose an appropriate exchange rate in terms of translating these particular figures. So let me ask you something based on this. Can I say this will be translated at the beginning of the year?
Yes, sir.
Can I say this will be translated at what rate? At the end of the year or at the average rate?
Average
Remember
rate. It is
this,
average
this
rate.
is, yes, average rate, because this is an item of expense and therefore an average rate. This is a payment at the end of the year, so closing rate.
Closing rate.
This is the closing balance, so the closing rate. And
Yes,
if
sir.
there is any difference in this particular ledger, this is a loan. It is supposed to be a monetary item, and monetary items, as per Index 21, are restated at the closing rate, and any foreign exchange gain or loss is going to be taken in the profit and loss account. Superb. So let's look at the exchange rates. I guess the exchange rates at the beginning of the year. So we given one currency unit, foreign currency, is 2.5. So let's multiply this with 2.5. And this is average, which is 2.42. And this is closing, that is 2.75. So let's multiply this with the respective rates. 58 into 2.5, that's 145 lakhs. 6.96 into 2.42, that's I think 16.8432 lakhs. Then 6 into 2.75, and I think that works out at 16.5 lakhs.
Yes, sir.
Great. And this is 58.96 into 2.75, 162.14 lakhs. Great. Now let's see what is the balancing figure in this ledger. And that balancing figure in the ledger is going to represent the foreign exchange gain or loss arising because of Index 21. So let's see what is the balancing figure. I think it's coming on the credit side. That's, I think, 16.7968 lakhs. 16.7968 lakhs, and this will be taken in the profit and loss account. So this is nothing but the foreign exchange loss on translation of the monetary item. So what do you say? Was this question too technical, hard, easy?
Easy,
I think
sir.
it was easy. What do you say?
Easy, sir.
Yeah, it is. Okay, so that was one particular question, which was on a financial liability, but I thought we'll do this particular question, a very interesting question, because it blends the concept of foreign currency along with the concept of financial instruments. Let's look at another question now, which is question number 7. And this is also an RTP question, November 2020. So let's now read this particular question, quite a similar question, but of course the category is going to undergo a change. It says an Indian entity whose functional currency is purchases a USD denominated bond. Is this an asset or is this a liability? I made a purchase. I made a
Purchase means
purchase.
asset,
So
sir.
it is definitely a financial asset.
Asset.
And we're given the fair value is supposed to be $1,000. The bond carries a stated interest at 4.7% on the face value. The said interest is received at the year end. The bond has got a maturity period of 5 years and is redeemable at 1250. Redeemable at 1250. Is it redeemed at a premium?
Yes, sir. Premium. Yes,
That's
sir.
right, because
Yes,
you purchase the bond, it says at 1,000, and assuming that, let's say, the face value is 1,000, though I'm yet to see where is the face value. So we can say, well, what this will trigger to. Can I say EIR again?
yes, sir. Yeah,
Yes.
yeah. Yes, sir.
Then we are given the fair value of the bond at the end of the year, and the exchange rates at the end of year one is given, and the exchange rate on the rate of transaction is given, and we are also given a weighted average exchange rate for the year. Then he says the entity determined that it is holding the bond as a part of the investment portfolio whose objective is to meet both holding the asset to collect the contractual cash flows and selling the asset. So, what category is he calling this? There is a dual objective of holding the asset for collections as well as the sale of the investment. So, what do you think is the business model indicating towards?
It's a mixed model.
Absolutely correct. So, what will be the basis of measurement? PNL, OCI, or AC? Blended model. The answer is also given that this is classified under the FPT OCI category. I think even if this is not given, I think it is implied very well in the question. The question very clearly tells you that the company's business model of holding this investment is to collect contractual cash flow and also to sell the financial asset. So we decided three business model. If it is maturity, it is AC. If it is sale, it is FPTPL. And if it is a mix, it is FPT OCI.
FETP. Yeah, yes, sir.
So it is very clearly stated. I think the examiner has also given you the clear-cut category, but I think even if this was not mentioned, it is quite implied in nature. And then we can see because of the premium factor, the effective interest rate of 10% is given. So can I say this is supposed to be a case of a financial asset at FPT OCI, R&R?
Or
That's right. It's a debt investment, so it is R. Calculate the gain or loss to be taken in the profit and loss and other comprehensive income for the year number one, and also pass journal entry. I think I'll make the ledger account. Then from that ledger account, I think you can easily capture the journal entries as well. So here again, you can see a blend in terms of financial instruments in India's 21. So my advice is that if you get this kind of a question, make two columns in the ledger account. First, concentrate on India's 109. And then you can convert the figures using the relevant exchange rates exactly the way we did out here. So let me just make a ledger here itself. So we're going to make two columns just like the previous question. So one is on the foreign currency and one is on the Indian rupee. My functional currency is clearly given to be INR and the foreign currency is USD. So this is a financial asset. So this is supposed to be a financial asset which is being prepared at FPTOCI, that is R, recycling. I sometimes feel, that there can be such beautiful questions which can be drafted. You could convert, the entire financial instruments with Indus 21 combination for financial liability assets AC, financial assets liability, all categories. So that could be a beautiful blend. Okay, so now let's consider this as USD and this is INR. This is USD and this is INR. Now let's change the focus. This is asset. This is not liability. This is asset. So let's, I think, again, start reading the inputs in this case, and we'll start deciding what is the accounting treatment to be done. So again, I'm reading, it says an entity whose functional currency is rupee purchases a bond at 1000. I'm not given any TC. By the way, had there been a TC, what do you do? Add or less?
We will add it, sir.
Very good. So in this case, I'll put the entry, this is bank, and we purchased it at $1,000.
Sir, I am
And
now I am very clear, sir. Where to add, where to reduce.
wonderful indeed. I'll still make that chart for a bit of clarity, I guess. Okay, so I think, and you know, all these charts will be a very good reference at the end of the exam, that when you revise, everything becomes very crystal clear at that particular stage. Okay, now I think let's go on to the inputs in terms of calculating the finance income. So will it be at the stated rate or will it be at the effective interest rate?
Sir, EAR rate, sir.
That's right. So 10% is my effective interest rate. So we take a 10% that comes to 100.
Yes, sir.
And then at the end of the year, we are also receiving the interest at the stated interest rate as well. So we're going to consider this as bank.
4.7%.
So this is going to be 4.7, I assume, is the face value given to me.
Face value, fair value is given. Face
Yes,
value,
and I think it says that the fair value of the bond is at
10.
its face value. So the face value also is 1250. So 1250 is the face value because stated interest will always be received at a face value itself. So 1250 into 4.7, that comes to approximately 59. It's not,
58.75.
yes, it is 58.75. Approximately, I'm taking it as 59. And then we consider the closing value. So are we going to take a balancing figure or are we going to consider a fair value? This is FPTOCIR. So you're going to take the balance CD as a balancing figure or you're going to consider fair value? Fair value.
Fair value, sir. Fair value.
That's right. So we're going to consider the fair value, and the fair value at the end of the year is given to me, it says is 1060. So this is the treatment as per Index 109. So what we made in the column so far is purely Index 109. So there is a difference in the ledger. Can I call that as a fair value gain or loss, which is going to be captured in the other comprehensive income, correct?
Yes, sir.
That's right. So 1060, 59,
19.
and that's 1100. So 19 is the
19
difference
rupees.
on the debit side. So can I say this will be taken where? Other comprehensive income.
OCI.
Yes, because this is not a foreign exchange gain loss. This is supposed to be a fair value gain, which is being captured in the other comprehensive income. Okay. Now comes the input in terms of translating this columns into the Indian rupee, that is the functional currency. So now we need to decide what rate is to be applied to each of these items. So let's begin. So what is the rate to be applied at the purchase date? Can I say the date on the date of acquisition, which is
Yes, sir.
supposed to be, I guess, 40?
40 rupees.
So this is going to be converted at the rate of 40. We'll multiply later. What about the balance CD? Sorry, this was not the purchase. So this is 40, sorry. This is 40. This is the receipt of the interest, I'm afraid.
Interest, that is interest.
Yes, so this is the amount of interest received. So this was 59. So opening will be at 40 and the finance income closing or average?
Finance income average.
That's right. So the average rate is at the rate of 42. And this money was collected at the end of the year. So at the closing rate, there is 45. And even the balance CD is going to be at the closing rate 45. What about this fair value change? Is it going to be average or is it going to be at the closing rate? Remember, this is computed at the end of the year when you took a fair value at the end of the year. So average or closing?
Closing.
That's right. So we're going to consider this at 45. Let's get the figures. And then if there is any difference in this particular ledger, can I say that would represent the foreign exchange gain or loss arising on account of Index 21?
Yes, sir.
So this will be 1000 into 40. That works out at 40,000. And this is 4,200.
Yes, sir. Then 855,
That's right, 855. This is 2,655.
2655. Yes, sir.
47,700.
47,700. Correct, sir.
And we can now comfortably see the balancing figure in the ledger that would represent the foreign exchange gain loss.
It will be coming in debit side.
5,300, I think, on the debit side is what we're getting as a balancing figure. This enters in the profit and loss account. Wow. So I think that is also interesting indeed. So, another thing which comes into play based on these two particular questions is that if you get any foreign exchange gain or loss arising out of these financial assets, it will be dealt in accordance with Ind AS 21. In both the cases, you can say this loan as well as this investment is supposed to be a monetary item in nature. So translation at the closing rate is taking place. And as per Ind AS 21, when monetary items are restated, the gain loss all enters the profit and loss itself. Wow. So I think that takes care of the aspect of financial assets accounting very clear. So I hope everybody is now very comfortable in terms of accounting for financial assets. Now let's focus our discussion on the TC chart. Then we'll come to the financial liability. So I'm just going to add one simple little chart further to avoid any confusions later. So let's give you another interesting chart. So this is the treatment of TC with reference to CFI, financial liability, as well as financial asset. So this is the accounting for transaction cost. So we'll take three aspects into account: a compound financial instrument, a financial liability, as well as a financial asset. So we'll look at the subcategories as well. Now, as far as financial liabilities are concerned, they are either at AC or they are at FPTPL. So financial liabilities are taken at only two categories, either at amortized cost or at FPTPL. There is no FPT OCI in terms of financial liability. And financial assets will be at AC or FPT OCI. It could be R or NR, whatever. And it could be FPTPL. And CFI, of course, is just one particular block, wherein you can say that you do a split accounting. And when you split this between the financial liability and the equity component. So I think let's make a summary chart on the accounting for TC in all these permutations and combination. So let's see the role of transaction cost in this case. Can I say in terms of CFI, what do you do with the financial liability element? Minus from the FL. It is
Yes.
reduced from the financial liability.
Yes, sir.
In terms of equity, can I say directly charged to equity? It is directly charged to SOKI, that is equity.
Yes, sir.
In terms of financial liability AC, tell me what is the accounting treatment?
We will reduce it from.
Absolutely same like
Yes, sir.
CFI. So reduce it from the financial liability. And what about FPTPL? Nothing. It is
Charge
supposed to
to
be
P&L
charged
directly.
to the PNL.
Directly.
Yes, it is charged to profit and loss immediately, directly. And what about financial asset AC? Added to the financial asset, correct?
Yes, sir.
And even in terms of OCI RNR, it is again added to the financial asset. And in terms of FPTPL, nothing. It is charged to profit and loss account.
Directly.
Yes. So I've given you two very interesting charts summarizing the position. Trust me, once you're going to revise, do questions and all, you'll get a very good hold. And you can, improvise on these charts, make your additions according to your inputs. Want to add some more inputs to these charts, do that. Great. Okay, so this is the treatment of financial assets. Now, I think before I go further, I think it's also necessary now to make your mind map in terms of the flow. Like Index 32, we've already got a very interesting flow. That Index 32 was focusing mainly on two areas which we covered. So one was the area of deciding the presentation, whether the instrument is equity or financial liability or a CFI. And then we did the detailed treatment of the accounting of CFI using a split accounting, where we also saw the role of the TC in a CFI calculations. Now, once we've come to Index 109, the focus is come on the holder. But it's not that Index 109 is addressing only the holder. It is also addressing the issuer as well. So I think before I proceed further, let me now map your mind in terms of the progress we're going to do in this standard. Let's take it further. So one thing which you need to clearly map up your mind. So this is also very important to keep the structure very clear, because what I feel at times, many people, many students get lost in the trail of the standard. That, how do I create an image in terms of the focus points in the standard? So I'm going to give you a focus point in terms of the trail. So watch this carefully. So I would say the standard is focusing, I would say, from two parties' point of view. So either we are looking at things from the issuer perspective, or we are looking things from the holder perspective. So when you're looking things from the issuer perspective, in this particular case, you apply Index 32. And where I gave you a simple three-step model. And with the help of the three-step model, you are able to decide that whether the instrument is supposed to be either a financial liability, or it is supposed to be equity instrument, or it is supposed to be a compound financial instrument. Now, this is what we learned in terms of Index 32. Now, we've already covered the accounting of compound financial instruments. This is already covered. We've already covered the concept of split accounting in terms of CFI. We have not done any accounting for equity instruments. And there is no difference in terms of accounting for equity instruments. If somebody were to tell you to give me an entry for issue of equity shares, you've done it in school level as well. Bank debit, equity share capital gets a credit, and if there is any premium, the share premium gets a credit. So there is no rocket science in terms of accounting for equity instruments. So we're not even going to discuss this element. I think this is implied how the accounting for equity shares issued, equity instrument is done. Now comes the element in terms of the financial liability, which I'm yet to discuss with you. And this aspect is discussed in terms of Index 109. Just to map this at this particular stage, when you look at the financial liabilities are supposed to be measured at AC, or they are measured at FPTPL. There is no category in terms of FPT OCI. So all the financial liabilities are taken in these two categories. And the default category in terms of liability is AC. So if you ask me, this is the default category. Though I think we'll do the question on that, but trust me, can I say if I ask you the preparation of financial liability at AC, you know it. We just did a particular question in the RTP, which was a financial liability at AC, though it was with Index 21, but you've already done it. And what's the big deal in terms of FPTPL? So we'll do one thing, we'll still make a chart. The way we created a chart for financial assets, we'll create a summary chart in terms of financial liabilities as well. So I will be giving you a short chart in this particular case shortly after this. So I think this takes care of the perception as far as the issuer is concerned, more or less. The issuer is done, so the focus now turns onto the holder. Now, coming back to the holder. So what did we do in terms of the holder? Can I say we started a journey in terms of Index 109? And in this case, again, I gave you a three-step model in terms of deciding the various measurements of financial assets. Because in this particular case, he is always calling this as a financial asset. Whether it is liability, equity, or CFI, he lands up saying it's a financial asset. But then we segregated We segregated this broadly in terms of two categories. One is the debt investments, and the other category broadly is supposed to be the equity investments. So we can say all the financial assets could be broadly classified in terms of debt investments and in terms of equity investments. Now, when it comes to the concept of debt investments, we got various categories like AC, we got categories like FPTOCI, that is always R, a debt investment is always R, and it is FPTPL. And similarly, when it comes to the equity investments, we said that there are two categories. One is it is supposed to be FPTOCI, which is always NR, and it is supposed to be FPTPL. And I think if you remember in the last session itself, we've covered all the five aspects of these permutation combinations. So the accounting for all the five categories is also done. So you're done with the accounting of financial liabilities, equity instruments, and CFI. You're done with the accounting of financial assets, all the permutations and combinations as well. And I've already given you a summary chart for all these categories as well. I've already given you a summary chart for the financial assets as well. So I hope you're able to now bind your mind in terms of the flow of the standard. That you should be clear in terms of issuer, the categories in accounting, in terms of holder, the categories in accounting. Correct? Now comes the journey forward. I'll be making a financial liability chart, no worries on that. So this chart is pending, which I'll do. Now, before the journey goes forward, your mind should now immediately come to one particular agenda. So I'll put this as a special issue. I'll put this as a special issue in terms of this accounting, which is my next focus area of discussion. That if there is a difference between a fair value and a transaction value, as we said, financial assets are initially measured at a fair value. So if there is a difference between a fair value and a transaction value, then we need to understand how is it accounted? How do we do the accounting for the difference between the fair value and the transaction value? Do you think the standard gets end at this particular stage? Of course not. Then what goes further are now certain special agendas. After this area gets over, then you can say we've got another areas of discussions on Ind AS 109. The other areas of discussion on Ind AS 109 is in terms of discussing the derecognition. 109 says recognition and measurement. So recognition and the measurement is done. Then comes the area of derecognition, where we need to discuss the derecognition principles for financial assets, the derecognition principles in accounting for financial liability. So once this particular area gets over, then comes the area of deciding the derecognition principles of financial assets and financial liability. The other area which comes in is the concept of impairment. But this is impairment only of financial assets. Liabilities are not impaired. The concept of ECL modeling. How the expected credit loss model is applied in terms of impairment of financial assets. And then comes the area in terms of hedging. How does a hedge accounting apply? So I would say these are the additional issues which are there as far as Ind AS 109 is concerned. The idea of making this chart is to map up in your mind that when you sit down on financial instruments, you're able to follow, okay, this is the entire inputs in terms of the standard. Though there are more fillers in between, which I've not, put that as a part of the macro chart. But I hope that gives you a macro view in terms of how the entire standard is to be binded in the minds.
Yes, sir.
Wonderful indeed. So now what I'm going to do, I'm going to first of all make a chart for financial liability, and then I'm going to go to the issue on special agendas of issues with you. Let's proceed. So you want me to do any question on financial liability, or I think that should be automatically taken care? Do you want me to do any questions on financial liability, or just the chart would do?
Yeah, you can ask the question, sir.
Okay, we'll do one question on that. Okay, not a problem. We'll do that. So let's first make a chart on financial liabilities, the way we did for financial assets. So this will summarize the aspects on financial liabilities as well. So basically two broad categories in terms of financial liability. So this is the summary chart. This is the summary chart in terms of accounting for financial liabilities. So one column for particulars, then amortized cost, and then FPTPL. So just to pinpoint once again, FPT OCI category is not present in terms of financial liability. So this is AC and FPTPL. So let me put some questions based on the discussions we have done, and you can decide. So first, when it comes to the initial measurement of financial liabilities, just like financial assets, all financial liabilities are taken at a fair value. But then there are two exceptions, the way there were exceptions in terms of financial assets. One is in terms of accounts payable. Just like account receivable, if there is an accounts payable, it is recorded at a transaction value. The second exception is in terms of loan which is payable on demand, which is also recorded at a transaction value. So same parity in terms of the exceptions which are there for financial assets. So we can consider first of all the concept of, we can say, initial measurement. First of all, let's discuss the concept of initial measurement. So tell me, inclusive of the concept of TC, that liabilities will be measured at what value for AC?
Fair value, we will reduce the finance cost.
Very good. So minus the TC, fair value minus the TC. So let me also pinpoint out here as a note as well that initial measurement is always at fair value. And then we can give the exceptions as well. And the exceptions in terms of liability is accounts payable. That would be at a transaction value. And the second exception would be a loan which is payable on demand. The loan which is payable on demand. Wow. Now let's come to the FPTPL. So what is the value at which the liability will be measured initially?
Initially, we will measure it the FE, and finance charges will charge to P&L.
Yeah, that's not called finance charge. It would be TC. That's issue expense, not
Yeah,
finance cost.
Yeah, issue expenses.
So in this particular case, we can say the TC is immediately charged to P&L. It is immediately charged to the profit and loss account. Great. Okay, then let's go to the next aspect, and that is on the subsequent measurement. So when I'm looking at the subsequent measurement in this case, my focus is working on the concept of fair value changes to be captured. So in terms of AC, are you going to consider the fair value changes?
AC, there is no fair value changes.
Yes, AC, we don't capture any fair value changes. And can I say in terms of FPTPL, yes, you're going to put
Yes,
the
sir.
fair value changes in the PL. Okay, let me also pinpoint one more inputs also at this particular stage, that as far as liability is concerned, you can say the default measurement category is supposed to be AC. FPTPL applies only when the liabilities are derivative liabilities, for example, the liabilities are held for trading, or the company has designated the instrument to be measured at FPTPL. So we can say that this FPTPL category applies typically in three circumstances. Either it is supposed to be a derivative financial liability, or we can say it is supposed to be held for trading, HFT, held for trading, or you can say that it is designated. It is designated to be measured at FPTPL. So other than this, you can say AC becomes a default category. Okay. So can I also call this fair value changes as unrealized gain or loss? Yes, of course. This is the unrealized gain or loss, the fair value changes arising at each balance sheet date. Now, there is going to be no profit or loss in this case, Because when we cover the aspect of derecognitions, then we'll see if there is any profit or loss on settlement of the liability. So not at this stage. Okay, so initial and subsequent measurements is done. Anything else which you want to put into this particular chart, or I think this is good enough for the liability part?
What about EAR?
Okay, that's great. So let's add the third point. So let's add the point on EIR. Good. So is EIR applicable to the AC?
AC is applicable.
Yes, it is applicable, but not applicable to the FPTPL. That's wonderful. Super. Okay, so financial assets, financial liability, the accounting is done. So let's do one question on the financial liability with you. So let me just come on to the question now on financial liability. Okay, so there is another interesting question which is also containing the aspect of, let me, I think, shorten this out. This is also in the study material as well. So I'll probably zoom it across. We're looking at question number 13. I hope it's visible.
Not now, sir.
Okay, I'll just zoom it across, no worry. This is a May 22 examination question, though there is one question on financial guarantee also, we'll see later. Visible, I guess?
Yes, sir. Visible, sir. Visible, sir.
Okay. So let's, I think, read this particular question, which is on the financial liability. This question contains one small little input further, which I've not yet discussed with you, and that is with reference to the processing fee. I have not discussed that, but I think we'll take care of that part directly through the question itself. Okay, so let's, I think, read this particular question. Let me, I guess, just a second. Okay, so let's, I guess, read this particular input. It says X made a borrowing. Oh, so we're given in the question that X made a borrowing from RGD Bank. So asset or liability, they made a borrowing.
Borrowing means liability, sir.
Undoubtedly liability.
Liability.
Yes, undoubtedly a liability. And then it says for 20,000 at a fixed interest of 12% per annum. Now there is a loan processing fees, which is paid additionally amounting to 1,000. And the loan is payable in 4 half-yearly installments of 5,000 rupees each. Now, the question is, what is the treatment of the processing fees which is attached to the loan? It's something similar to the concept of TC. Nobody asked me, and I also did not answer that question, that, when I said that processing the transaction cost is added to FA or it is reduced from FL, nobody asked the logic. I presume that you knew that why is it added or why is it deducted. Is that correct? Am I going with the correct presumption that you know the logic of why it is being added or why it is being reduced? Okay, the silence is speaking something else indeed. Okay, so first let's give you some basic logic on this end. Just watch the inputs carefully to understand the basic logic. I'm talking in terms of TC. Let's consider the case of a financial asset. When you buy a financial asset, the entry is financial asset gets a debit and the bank gets a credit, and this is at the fair value. Now, when you incur a TC, you would say the entry becomes TC account debit and the bank gets a credit, and this is the amount of TC which is incurred. So instead of debiting the TC, what we are doing, we are debiting the financial asset. So now see the logic that if the financial asset is debited at fair value, debited at TC, can I say what is the conclusion? That you are recording it at fair value plus TC. Did you get the logic?
Yes, sir.
Nobody asked me that earlier. I thought you know why is it being added as well. Okay, let's have a look at the financial liability element as well. So if you look at the financial liability, can I see the entry at the time of raising a financial liability, bank gets a debit and financial liability gets a credit again at a fair value.
Yes, sir.
And when you incur a transaction cost, the entry is transaction cost gets a debit and the bank gets a credit, and this is with the transaction cost. So instead of debiting the transaction cost, what we're doing, we are debiting the financial liability. So you can see the financial liability got a credit and then a debit. So the net impact is that the financial liability is recorded at a fair value minus the transaction cost. There is a logic that why the transaction got gets added for a financial asset and gets reduced for a financial liability. There is mathematical logic. The other logic is that the transaction cost which is incurred for the entire life of the instrument. So why should you immediately expense it? The moment it gets incorporated in the EIR, can I say it gets automatically spread over the life of the instrument? Because when you are going to consider the calculation, the amount of TC in the calculation of the effective interest rate, indirectly what is happening, that this amount is getting deferred over the life of the instrument as well. And if it is getting deferred over the life of the instrument, there is a spread over which is taking place. Now, on a similar lines, the question what comes is, if there is a processing fee, if there is a processing fee, so what do you think would be a logical treatment in terms of financial asset and in terms of financial liability? Tell me. I gave a processing fee to the bank. So can I say when I took a loan, the entry is bank debit, financial liability credit. I paid a processing fee. So processing fee debit and bank gets a credit. So what do you think we should do for a financial liability for a processing fee? Add or reduce?
Reduce.
So I will basically take the fair value, and from the fair value, we'll reduce the processing fees as well. And what about the financial asset? Can I say in this particular case, we can say the bank gives a loan. So they put the entry financial asset debit and bank gets a credit. They get the processing fee, bank gets a debit and processing fee gets a credit. So what will be the treatment in terms of financial asset? Can I say again, it'll get reduced? Do you see the contrast now? In terms of TC, there is a different accounting treatment. The TC is getting added to FA and reduced from the FL. But the processing fees is getting reduced from the FA as well as the FL. Because the person who takes a loan credits the FL, and then when he pays the processing fee, debits the FL. The person who is given a loan debits the FA, and when he gets a processing fee, credits the FA, and therefore the processing fee in both the cases gets a reduction. And if this happens, let me also ask you another question as well. If this happens, will it also give rise to the calculation of EIR? Will this trigger the need to calculate the effective interest rate as well? Yes. So which means the presence of a discount, the presence of a premium, the presence of a TC, the presence of processing fee. Now the list has become 4. So the presence of any of these elements will lead to the calculations of effective interest rate. I hope I am clear with the agenda.
Yes, sir. Clear, sir.
Wonderful indeed. So let me do another small little thing as well. I think let me just go back to the chart on TC and add this element out there. I just want to add that element out there because we were discussing that agenda. Where did the chart go? This was financial liability. This was the comprehensive chart. Yes, let's, I think, put this out here as well. Since we're talking in terms of TC, let's, I think, also blend out here the concept of processing fee as well. So let me also add the concept of processing fees also out here. So let me just directly put it out here. So tell me in terms of financial asset plus or minus, and in terms of financial liability plus or minus.
Both case minus only.
Wonderful indeed. So this is going to be less the processing fee in both the cases. When you take the fair value, you reduce the processing fees for the asset as well as a liability as well. Wow. That is wonderful indeed. Now, let me just come back to the question once again. So let's come back on this question number 13. It says X made a borrowing from RGD Bank, and that is at a fixed interest of 12% per annum. The loan processing fees is additionally amounting to 1,000, and the loan is payable in 4 half-yearly installments, 5,000 each. So we're given the loan amount and the date of start and finish is given. It says the repayment of the loan starts on 30th September to be paid on a half-yearly basis. The interest is charged and paid on a quarterly basis. Oh my God. And then it says the interest is 12% per annum. There is an upfront fee. The upfront fee is nothing, but it is the processing fee which the question is talking on. So compute the interest to be taken to the P&L every quarter over the period of loan, and the effective interest rate is 16.6%, 5-marker in the exam. If you actually ask me, I think it's too much of a task for a 5 marks, frankly speaking, because in this particular case, you've got quarterly interest and half-yearly payments. So it's going to be quite a comprehensive inputs indeed. So I think I'll just make a ledger account for just 1 year. I think you can make the second year ledger on your own on a similar lines. I think that works, right? Okay, so let's, I think, begin with the ledger on the financial liability. So we're going to make a ledger account for the financial liability. So this is going to be made at amortized cost by default category. So we'll take the financial liability at AC. So let's, I think, first of all, go with the inputs. So I am given the bank loan is for 20,000 with a fixed interest 12% and a processing fee 1,000. And this is on 1st April 2020. So on 1st April 2020, give me what is the amount at which the financial liability will be recorded at. The loan is taken for 20,000 with a processing fee of 1,000. So what will be the value of initial recognition?
19.
19,000.
That's right. So 20,000 minus the processing fee, this gets recorded at 19,000. Now we need to be careful on the dates. The repayment of the principal is 6 monthly, but the interest is calculated on a quarterly basis. So we'll consider, first of all, the interest at the end of the quarter. Can I say 30th June 2020?
Yes, sir.
Do we consider the finance charge at 12% or at 16.6, which is EIR? So of course at EIR, so we consider the interest on 19,000. Can I say at 16.6% for 1/4 of the year, 3 months?
Yes, sir.
So 19,000, 16.6, 1/4 is around 789 approximately.
788.5. Yeah, 789.
That's right. Now, can I say again, I'll put another entry on 30th September because the principal is paid in 4 half-yearly installments. So you'll again go to consider interest on 30th September.
Yes, sir.
And this interest will be taken on, can I say, the total balance, including the finance charge as well.
Yes, sir. Compounder.
So 19,000 plus 789, it comes to 19,789. So we again take 16.6% for 1/4 of the year.
It's
I
coming
guess 821 approximately.
821.24. 821.
Wonderful. So 821 approximately. So this is the status of the interest at the end of the first quarter, the status of interest at the end of second quarter, and then on 30th September 2020, you're going to make a payment as well. And can I say the payment is to the extent of 5,000, the principal money?
Yes, sir. 5,000.
Okay, so before that, my mistake. We went something wrong on that. Interest is paid quarterly. Sorry, we went wrong on the calculations. My error. We also need to pay interest in between. We also need to pay interest. I think I missed out. I did the accrual of the interest, but the payment is missing.
Okay.
So let's take on 30th June, you pay the interest as well. That is bank. So interest will be paid on what amount? Can I say that will be on the face value?
Yes, sir.
20,000.
20,000.
We got to pay that 12% was the coupon rate, I guess. Yes, there is a fixed interest of 12%, which is for again 1/4 of the year. So 20,000, 12% for a quarter is 600. Okay, now let's consider. So this is the entry which is done. So can I say on 30th September, we will be calculating the interest on this outstanding balance. Is that correct?
Sir.
I'll just see what is the sum total of the net balance at this stage, and the interest will be computed on the outstanding balance.
Yes, sir.
So 19 plus 789 minus 600, that works out at 19,189. At the rate of 16.6% for 1/4 of the year.
796.34.
Right, so approximately 796. And then again, we make a payment on 30th September 2020. Can I say this amount remains the same at 600?
Yes,
And
sir.
we should also add another 5,000, which is the principal repayment, correct?
Yes, sir.
Because
Offset
we
it.
will pay the principal money of 5,000 and the interest as well. So the interest and the principal is paid on 30th September. Okay.
Yes, sir.
But we cannot close the ledger at this stage. We need to carry forward this particular ledger. And now the entries will be done on December. So we got to do the entries on December 2020. So let's see what is the balance CD effectively at this stage.
Not bad.
789,
Go.
786. So I think the effective balance is 14,385, I guess. So 14,385, I think is the balance. Just check this. 19,789,
Yes, sir. Yes, sir.
796.
Yes, sir. 14,385. Correct.
Wonderful indeed. So we take 16.6% on this for again 1/4 of the year.
It's coming 596.9.
Yes,
597.
so 597 approximately. What next? Can I say again a payment on 31st December 2020? 600 is the payment.
Yes, sir.
I'll just make 1 year ledger, though it's asking you to make the ledger account for every quarter over the entire period of the loan. So I think that's a little extra calculations for a P5 marker, I guess. Let's again consider the interest charge on 31st March now. 31st March 20. Let's see what is the balance. 789, 796, 597. 14,382, I guess. At the rate of 16.6 for 1/4 of the year. I guess around 597 again. This comes to 597 once again. Then we pay this money on 31st March 21. How much money are you going to pay on March 21?
It will be
The interest and the principal both once again. So this is
Yes,
going to
sir.
be 600 plus another 5,000. And then we can comfortably take the balance CD as a balancing figure. So this is a ledger for year 1. And on similar lines, you can make a ledger account for the second year as well. I'll just take the balance CD in this case. This is, I think, coming to 9379 is the balance carried down.
Yes, sir.
Wow. So I think that takes care of the inputs in terms of how the financial liability is accounted under amortized cost approach. Wow. So this is done. I guess you can easily prepare the ledger account for the second year on a similar lines, I guess. I think so.
Yes, sir.
Great. Okay, now we're done with the accounting of financial liability, accounting for compound financial instruments. We're done with the accounting of financial assets, all the five permutation combination. Now we are going to go to the special issue of discussion, which I said that if there is a difference between a transaction value and a fair value, then what do we do? So let me now first go on to that particular discussion. We'll just make some background before we'll give you a break. First, we'll just create a little background on that part. And then I'll give you a break after that discussions is done. So let's, I think, first discuss the inputs with reference to transaction value and a fair value difference. Okay, so let's now create another chart at this end. I think I'll just take the addition here itself. Now we are coming to the discussion that is on a special issue. That is on a special issue when there is a difference between the fair value versus the transaction value. The fair value versus a transaction value. So let me first give you the thought process, then we'll start working on this.
Okay, sir.
So we've already seen that financial assets are recorded all at a fair value with the two exceptions. So now the question rises that if you record the financial asset at a fair value and the transaction value is different, then what do we do? But the main question is, why would it be different? Let's take an example to understand the concept of what is called an off-market transaction. Imagine a company gives a loan to the employee. So they know that the market rate of interest prevailing is 15%, but they give a loan to the employee at a concession and let's say at the rate of 9%. So can I say, since the market rate of interest is at the rate of 15% and the loan is given, let's say, at the rate of 9%, we can say it's an off-market transaction. And there can be a couple of transactions which can happen at off-market levels. And typically when there is a related party transaction or not necessarily a related party, though the list can be endless in terms of off-market transactions, but typically if you look at the kind of questions which are there, which have come in the exams or discussed in the study material, I would say broadly there will be three categories of off-market transaction. So your very first approach in terms of looking at the question is to see that is there any off-market transaction? And off-market transactions would mean that the examiner would give you that what is the prevailing market rate of interest and what is the contracted rate of interest. If you see that the market rate of interest and the contracted rate of interest is different, and typically the market rate of interest will be greater as compared to the contracted rate of interest, that would indicate that this is an off-market transaction. And the moment it is an off-market transactions, there will be a definite difference between a fair value and a transaction value. Rather, I would say the transaction value will be greater as compared to the fair value. So in these particular cases, I would say we can broadly divide the transactions into three parts. We need to see that is there an employer-employee relationship, then the accounting treatment is going to be different. For example, the employer is given a concession loan to the employee. So this is an off-market transaction. And how do we tackle the difference between the fair value and the transaction value? Second, you could see a transaction between the parent and the subsidiary company. So the parent and the subsidiary might have some loans between them, and the interest which is paid by the subsidiary, let's say to the parent company, is below the market rate of interest. Because the parent wants to give a concession loan to the subsidiary, or the subsidiary wants to basically take advantage of a low rate of interest. So in those cases, you will see the market rate and the contracted rate will be different. That is another kind of relationship. And the third kind of relationship you will see is between the customer and you can say the supplier. For example, many times you might pay a security deposit to the supplier. And those security deposits may either carry no interest or a very nominal rate of interest as compared to the market rate of interest. So I would broadly say that you will see three kind of transactions which are there when the market rate and the contracted rates will be different. Either it's going to be an employer-employee relationship, or it is going to be a holding subsidiary relationship, or it is going to be a case of a customer supply relationship. And there is a particular concept in each of these cases how the difference will be tackled. So let me first map this chart. So we can say that this concept of fair value versus transaction value arises. This is going to arise when there are off-market transactions. When there are off-market transactions. So when you're going to get off-market transactions, that means the transactions are taking place not at the market rate of interest. So your first focus point in the question would be to see that is there any off-market transaction in the question? If yes, then this concept will trigger. So how do you identify it's an off-market transaction? You will see that the market rate of interest is going to be definitely greater than the contracted rate of interest. And the moment you find that the market rate of interest is greater than the contracted rate of interest, undoubtedly the transaction value and the fair value will differ. And this will also mean that your transaction value will definitely be greater as compared to the fair value for sure. And just as I said, you are going to see three kinds of transactions. You're going to see typically three kinds of transactions in this particular case. One is a case of an employer-employee relationship, concession loan. So you would see the one kind of transaction is employer-employee transactions, which will be typically, let's say, a concession loan. We'll see in the questions how you identify this, but there could be an employer-employee, concession loans given by the employer to the employee. The second could be a parent-subsidiary relationship. If there is going to be a parent-subsidiary relationship, that would again be a concession kind of a loan. So maybe again a concession loan between the parent and the subsidiary. That would be an off-market transaction. Or it could be in terms of a supplier-customer relationship. It could be a supplier and a customer relationship, which could be on account of a interest-free deposit, which could be in terms of an interest-free deposit. So I would say, looking at the kind of questions which come in the exams or which are given in the study material, I broadly consider these are the typical three situations where you will see off-market transactions happening. So at the very instance, when you read the question, you will clearly see that there will be a difference in the market and the contracted rate, and which will undoubtedly mean that your transaction value is definitely more than the fair value. And in which particular case, now we need to decide that depending upon the category of relationship, my accountings will differ. How does the accounting differ? That we'll discuss in these three situations, but I guess after the break on that. So my focus now after the break is going to be on these three cases, that in these three cases, if you get a difference in transaction and fair value, how do you account for those differences? And where do we take the difference, and how is it accounted for the life of that particular, you can say, instrument? But I think first, let's give you a 10-12 minutes break to relax your minds before we take the journey forward. I'm sure you need one. So let's take a break, friends. Enjoy your break. I'm going to join you in 10-12 minutes time.
Sir, 1 minute, one question.
Yeah.
So in this case, when the market rate is high, the contract rate is less, then
Yes.
there is a off-market transaction is exit.
Absolutely.
So in this case, what is the fair value in this case? Fair value means the contract rate of interest is the fair value?
Present value of the inflows discounted at the benchmark rate, which is market rate.
Okay.
No worry, we're going to work upon that. That's what the agenda of discussion is. But we're going to consider that whatever inflows you're going to receive, I'm going to discount those inflows at the benchmark rate, which is the market rate. Like, for example, if you remember, in terms of CFI, we discounted the
Yes, sir.
financial liability at a benchmark rate, which was, again, interest
Non-convertible.
on non-convertible instrument.
Yes, sir.
So here also what I will do, when I will calculate the fair value, I will say what is a fair value? The money which you're going to receive in the future, which is nothing but the present value of the future inflows. And if you're going to take the present value of future inflows, the benchmark rate will be the market rate. Now imagine if I am supposed to get 100 with a 6% interest, but you discount it at 10%. You'll not reach the figure of 100. You reach a figure less than 100. No, no worry on that. That's what the area of discussion is. How do you calculate a fair value in these cases? That is one. How do you take the difference between transaction and fair value in the books of accounts? That is two. So we'll get clear on that. Don't worry on that.
Okay, sir.
Yeah. Okay, so let's meet you in 10, 12 minutes time, friends. Enjoy your break.
Okay, sir. Thank you.
Thank you. Mind. Now, I think let's come back to the agenda of a special issue, and that is the difference between a transaction value and a fair value. So, just to remind you, one or two key aspects of this, and then we can elaborate this concept with questions and all. Well, I think the first step, what you need to do in every question is look at the fact that whether the transaction is at off market terms. Now, how do you say that the transaction is at off market terms? That is when you compare the contracted rate between the parties and the market rate of interest. Undoubtedly, the market rate is more than the contracted rate. If that be the case, there seems to be some kind of a concession which you are trying to pass on to the other party. So in this particular cases, we will definitely notice that if market rate and contracted rate are different, undoubtedly it'll lead to a difference in transaction value and a fair value. Now, one more input which I like to add at this particular stage. Technically speaking, the difference between the transaction and a fair value is to be accounted for depending the source of the fair value as per Ind AS 113. I know I didn't say that earlier, but I'm just adding that inputs now. So one thing is pretty clear that if there is an off-market transaction, the contracted and market rate will be different and the transaction value, fair value will undoubtedly be different. But in this particular case, you need to watch out and identify that this difference is due to the fair value computed as per what inputs in 113, Ind AS 113. There are basically, you can say, two kinds of fair valuation calculation. One is which is based on observable inputs, and one is which is based on unobservable inputs. So if there is going to be a difference in the transaction value and the fair value, and this fair value is sourced on observable inputs, the difference is taken to the profit and loss account immediately. It's called a day one gain or loss. And in a situation where the fair value is computed based on, you can say, unobservable data, then in that particular case, the difference is not immediately taken to the P&L, but I would say depends upon the kind of relationships which you see. So I think let's do one thing. Let's translate this concept into a three-step model for ease of understanding. So what we can do in this particular case, I would say if I were to summarize this input in terms of a simple three-step model, I would say in terms of step one, see that it is an off-market transactions or not. How would you identify that it's an off-market transactions? When you compare the contracted and the market rate is more as compared to contracted rate of market transaction. If you say it is an off-market transaction, you go to the step number two and identify the source of the fair value. Is the source of the fair value observable data or is it unobservable data? If it is supposed to be observable data, the difference in transaction and fair value goes in the P&L. It's called a day one gain or loss. So this will be taken in the profit and loss. It is called a day one gain or loss as the case might be. But if it is unobservable, then you can go to the step number three and look at the type of relationship which is there. The type of relationship is these three. Is it employer-employee? Is it parent-subsidiary? Or is it customer-supplier relationship? And depending upon the type of relationship, you accordingly deal with the inputs. I know the next question, what is coming to the mind is, so how would I identify that it is observable or unobservable data unless there is any explicit inputs in the question? I would say assume it is unobservable and you can go the other way around. That makes life simple. If you see in the question the type of relationships mentioned, I think you can comfortably go with the fact that it is unobservable data in nature. So we are going to do now three questions looking at employer-employee, looking at a parent-subsidiary, and looking at the concept in terms of customer-supplier relationship. And let's see how the fair value will be taken, how the difference in the fair value and the transaction value will be taken. So let's begin the journey with a question with you. So I'm going to first take you to the question on employer-employee relationship with you. Okay, so I think this question has to be a little adjusted because I now need to take you to the question below. Okay, so I think I'll need that input. I hope the question is visible, right?
Yes, sir.
So let me just, I think, clear this part. So this is a question which is on employer-employee relationship. It's an examination question, November 2020, 12 marks in the exam. So let's, I think, read the inputs in the question. So we're going to apply a three-step model. We will first of all evaluate whether there is an off-market transaction, and then see the source of the fair value, and then see the kind of relationship. Though I've already told you the type of relationship is employer-employee, so I think we're focusing on that part only. But we'll still see off-market transaction. On 1st April 20, S advanced a housing loan to one of its employees at an interest rate of 6% per annum, which is repayable in 5 equal annual installments along with interest at the end of each year. Now, this is interesting. Is this 5 equated installments inclusive of the interest, or is it 5 equal principal installments? Mind the language carefully. It says in 5 equal installments, along means plus
Plus interest.
interest at the end of each year. So 5 equal principal installments or equated installments?
Equal installment, both.
Principal. It'll be 5 equal principal installments because it says 5 equal installments, then it says plus the interest as well. So we're going to pay 5 equal principal installments in this case. The employee is not required to give any specific performance against this benefit. Now it says the market rate of similar loan is supposed to be 10%. So let me ask you, can I outrightly reach a conclusion that if the market rate is 10 and the contracted rate is 6, it's an off-market transaction, undoubtedly?
Yes, sir.
Yes. And the moment you see that the market rate is 10 and the concession rate is 6, it is undoubtedly transaction value and fair value will undoubtedly differ. The accountant of the company recognized the staff loan in the balance sheet equal to the amount of the housing loan disbursed, that is 15 lakh. So this 15 lakh is supposed to be a transaction value because the loan is taken for 15 lakh. So that is called a transaction value. So what the accountant did, he recognized the loan in the balance sheet at a transaction value, which is incorrect because financial assets are to be recorded at a fair value and not at a transaction value. The interest income for the year is taken at the contracted rate in the statement of P&L, that is 6% on 15 lakhs. So even that goes wrong. Because if you're going to record the financial asset at a fair value, then in that particular case, the interest income is not going to be based on the contracted rate, but on the benchmark rate, which is 10%. And that also not on 15 lakhs, but on the fair value. Then he says, analyze whether the above accounting treatment done by the accountant is in compliance with the relevant Ind AS. Then he says, if not, I sometimes always tell people that the question at times is trying to give you an answer. When it says, is this the accounting treatment? If not, tell me the treatment. It's like telling you the treatment is not correct. So it says, if not, advise the correct treatment of housing loan, the interest and the other expenses in the financial statement. It talks about other expense. Which other expense is it talking of? He says, advise the treatment of the loan, the interest and the other expense. Which other expense is he talking of? Is there any other expense given in the question?
No, sir. It's a difference between 10% and 6%.
Yes, exactly correct. The difference between the 10% and 6%. And then it says, along with the workings, you are required to explain how the housing loan would be reflected in the Ind AS compliant balance sheet on 31st March 21. So I think in this particular case, let's, first of all, do the calculations. We may not make the ledger account for the entire tenure of the loan, but let's, first of all, visualize this. So question number 8. So what you're going to give to the examiner is the inputs like this. At the first instance, you need to tell the examiner that, yes, I've got the point, that there is a difference in market rate and on the contracted rate. So we'll tell the examiner that the market rate is supposed to be 10% and the contracted rate is supposed to be 6%. So this indication of 10 and 6% indicates that it is supposed to be an off-market transaction. The transaction is on off-market terms. So tell the examiner that this is an off-market term transaction. And since we already know that it is an employer-employee relationship, let me directly give you the entry. So this is based on an employer-employee relationship. So let's understand the entry which will be done at the initial recognition of the financial asset. The financial assets will be recorded, that is a loan given to the employee. This is going to be recorded at the fair value. And the money which the employer gave, that is bank gets a credit, which is at the transaction value. So as far as the transaction value is concerned, it is clearly given, it is 15 lakh rupee. The question arises, what is a fair value? That's, I think, what the question you had asked. The fair value is what? When the employer gave a loan, he is going to get the interest in the future. He's going to get the principal in the future. So the present value of all those interest and principal discounted at the benchmark rate, market rate 10%. So for this particular purpose, we will take the present value of future cash inflows. So whatever is the future cash inflows, that would be taken. So when you consider the present value in this case, the present value is going to be using a discount rate, which I can say is the benchmark rate, which is supposed to be the benchmark rate, and that benchmark rate is the market rate of interest. So now in order to calculate the present value of the future inflow, what do you need to do? You need to organize all the inflow. You know, the loan is payable in 5 equal principal installments with the interest. So make a chart, get all the future inflows and take a discounting at the rate of 10%, which will do that. So naturally, there will be a balancing figure which will appear on the debit side, and this balancing figure is going to be called as a staff cost. This balancing figure is going to be called as a staff cost, and this staff cost is going to be spread over the life of the loan. Even though we are not demanding any specific performance from the employee on account of giving him a concession loan, irrespective whether you demand a particular performance on account of this loan or not, that doesn't make a difference to the accounting treatment. But this loan is being given, and this is like a perquisite value, and this perquisite value staff loan is going to be spread over. This is what we can say is the other expense, and this other expense is going to be spread over life of the loan. This is going to be spread over the life of the loan. I hope you got the picture of the accounting treatment. So we need to basically consider that the financial asset, the loan, is captured at a fair value, present value of all the future inflow. The bank is, of course, with the transaction value 15 lakh, and the difference is the staff cost. It's like a prepaid staff cost, which is going to be amortized on a straight line basis over the life of the loan. Right, friends? I hope I'm clear with the picture. So let's now make a chart wherein we want to get the present value of the cash flow. So let me, I think, create a chart to calculate the fair value as well. So we'll make the computation of fair value. So let's see the computation of the fair value in this case. So I think I'll just keep the question open with me. So in this particular case, let's create a chart. I think the loan is for a period of 5 years, I guess. So we've got 5 years. So the principal amount of the loan was supposed to be, I guess, to the extent of 15 lakhs. So can I say the cash inflow on account of principal? Can I say is going to be 3 lakhs each year? Because this is going to be paid, can I say, at the end of each year? So the principal amount is going to be repaid 3 lakhs in 5 equal installments. So 15 lakhs spread over a period of 5 years, it comes to 3 lakhs. And let's also calculate the interest as well. So if we calculate the interest, can I say on 15 lakhs, what was the contracted rate? 6%. I guess 6% on 15 lakhs is 90. Can I comfortably reduce this interest by 1/5 every year? Because your principal money is being paid 1/5 every year. So can I say the outstanding interest will also keep reducing 1/5 every year? So the interest is going to be 72. Keep reducing by 18, it is 54. Then it becomes 36. And then it becomes 18. So let's now take the sum total of this. So this is the future cash inflow, which is to be discounted at the market rate, which is 10%. And we're going to get the present value. So the present value of all these inflows will equal what is called the fair value. So let's consider the figures. This is 390. This is 372. This is 354. And this is 336. This is 318. And we consider the discounting factors at the rate of 10%. So I think this is going to be 0.909, 0.826, 751, 683, and 621. So we take the present value of all these inflow. So would you like to give me what is the present value of all these inflows put together? Couple of calculations indeed. So 390 into 0.909, this is 354,510. 307,272, 265,854, 229,488, 197,478, and let's take the sum total of all this.
13,54,602.
Okay, 13 lakhs 64.
54,602.
Oh, sorry, 1354.
602. 13 lakhs 54,602.
Okay, great, wonderful indeed. So 1354,602, that becomes the present value of all the future inflow. So let's come back to the entry. So this is 1354,602. So this is 1354,602. So we can get the balancing figure. Let's see what is the balancing figure. That is the prepaid staff cost. 15 lakhs minus 1354,602, 145, 398. Right. So can I say now it becomes an ordinary question itself? Once you made the segregation of the fair value and the transaction value, it becomes a normal question. So can I say this financial asset, that is a loan account, is now going to be prepared at AC. So what are you going to do? You're going to accrue the finance income at the rate of 10% on this balance and keep receiving the inflows whatever is coming. You want me to make a ledger account for the financial asset for 1 year?
Yes, sir.
Okay, so let's, I think, make this for 1 year. Let's give you the staff cost and the asset account both for a period of 1 year. Then similarly, it will be made for the other years as well. So we're going to make 2 ledger accounts. One is the loan account, and let's also create a staff cost account as well. So this is the financial asset at amortized cost, and we'll also consider the staff cost as well. So let's consider the financial asset at AC. So this is bank. So this was, I think, 1354,602, correct?
Yes, sir.
Yes. So let's, I think, concentrate on this ledger account for the first year. So we'll make the finance income due, can I say, at the rate of 10%, which is the benchmark rate. And you would also recall that there is a fundamental principle in entire Ind AS. Whenever you consider a present value of the inflow outflow, trust me, what happens in the subsequent year is compounding. In order to calculate 1354, you took a present value at the rate of 10%. That was discounting. Now we're going to do compounding, which is called unwinding. So indirectly, what you're doing out here is nothing but unwinding. So 10% would mean 135460. Then we're going to receive the interest at the end of the year with the principal. I guess we can look at this chart.
3,60,000. Sure, 390.
390.
Yeah.
So first year we get 3,90,000, the principal and the interest repayment, and we take the balance CD as a balancing figure. And that's how this ledger account will continue for the next 5 years to go. So that should not be a problem, I think. So 1354,602 plus 10%. I think this is coming to almost 11,62,000. 11,000,62.
Yes, sir. 11 lakhs.
So I think the other 4 years would be manageable because they will be prepared absolutely in the same lines. You'll keep taking the interest income, getting the money and the balance CD. Now let's go to the staff cost as well. So in terms of the staff cost, we put the entry bank. So what was the difference? Transaction and the fair value difference? It was 145,398.
Yes, sir.
So what do? We take this on a straight line basis and chart it off. So 1/5 of this is going to be taken in the P&L at the end of each year. So let's take 1/5 of this and take the balance CD as a balancing figure. So this will be a straight line amortization. So divided by 5, it comes to 29080. So 145,398 minus 29080. This is the balancing figure 116318. And this will be amortized on a straight line basis for the next 5 years. As simple and as straight. So I think we've tackled one particular situation where there is an employer-employee relationship, which means the entry in the books of employer is the loan or the financial asset at a fair value. Can I say present value of all the future inflow at a benchmark rate discounting, which is the interest at market term. So the bank is going to be with the amount of transaction value. The difference becomes a prepaid staff cost, which is amortized on a straight line over the life of the loan. I hope the first case is clear.
Yes, sir. Clear, sir. Sir, here the idea is difference between the market rate and the contract rate. We are considering as a income now. That is
the it's difference. Not an income for the employer; it's an expense for the employer. Because the employer, yes, because what the employer is doing is saying that instead of charging you 10, I'm charging you 6, I'm charging you 4% less. So indirectly, it's a perquisite kind of a loan. The company is charging a expense every year for the perquisite value which is being given.
Sir, I mean, it's an income for employee, expenses for the employer.
Yes, that you can say. But since we're looking at the accounting treatment in the books of employers, so I here said it's an expense. Yes, for the employee, it's a perquisite income, but for the employer, it becomes an expense. So therefore, he's amortizing the difference in the books of accounts. Correct. Okay, let's now have a look at another kind of question. And this, we want to see a holding subsidiary as well. Okay, I think first we'll take a deposit one. Let me just, I think, show you another question as well. So we've got 2 questions. Maybe we can see question 10 first. And then we'll come to question number 9. I hope it is visible. You can see the question number 9 and 10.
Yes, sir.
So let's first look at the question number 10. It says S issued redeemable preference shares to the holding company H. And the terms of the instrument are summarized below. So this is redeemable after a period of 3 years starting and the end date is given. And we are given the dividend rate is 0% effectively. and the market rate of interest is 12%. Does this indicate it's an off-market transaction? Undoubtedly, yes.
Yes, sir.
Because the dividend which the subsidiary is giving to the parent company is zero, whereas the market rate of interest is 12%, it's an off-market transaction. And we know that if it is supposed to be a holding subsidiary relationship, I think I'm assuming that the data is based on unobservable inputs. Now, let's see the accounting treatment. Analyze the given situation applying the guidance in the books of H Limited. So let's see. And I think in this case, I would also like to discuss the treatment in the books of H as well as S. Because typically when it comes to employer-employee, naturally employees are not going to do accounting typically as per Ind AS. So our focus was on the books of the employer only. But when it comes to a parent-subsidiary relationship, the accounting is going to be done by the parent also and subsidiary. So let's look at the entry from the point of view of the parent who invested in this loan and from the point of the subsidiary which issued this particular loan. So let's first of all conceptually see the accounting entry in the books of the parent and the subsidiary. So let's see the accounting entries which will apply in the books of the holding company and in the books of the subsidiary company. Now, one thing is very clear that he invested in the preference shares of the subsidiary. So we'll put the entry investment in the preference shares debit. And can I say this will be at the fair value? And can I again say that the fair value is what? The present value of all the future inflow. I'm not getting any dividends. So can I say only the principal repayment will be discounted at the benchmark rate of 12%? So we get the fair value. And the bank gets a credit, which is, of course, at a transaction value, creating a difference in this entry. So there will be a balancing figure in this entry, and this balancing figure is going to be called as a deemed equity investment. It's going to be considered as a deemed equity investment. So we're going to consider in this particular case that there is a deemed equity investment in this particular case. Because in this particular case, you can say you're investing some money and getting something back. So the investment in preference share is more like a financial liability for the issuer, and it becomes a financial asset debt investment for me. But this money which is being pumped into the company, you're not getting anything back in return. So if you're not getting anything back in return, it's more like an equity instrument issued with a subsidiary, and therefore it becomes a deemed equity investment for the parent. On the same lines, if I look at the subsidiary company, he will put the entry bank gets a debit, which is of course at the transaction value. And he would record the preference shares, which is supposed to be redeemable preference shares, as a financial liability, which will be at the fair value. So there will be a balancing figure which will get created in this entry as well. And can I say this can be called as deemed equity instruments? This can be called as a deemed equity instruments, which is there. So we are indirectly saying that the subsidiary has issued equity instruments. So it's a deemed equity instruments at their end as a liability side of the balance sheet, and he's made a deemed equity. So let me put it as investments for a clarity of thought. So this is the entry which will be done in the books of parent and the subsidiary. And when you go to consider the concept of a fair value, so fair value in this particular case is the present value of the future cash inflow, rather the future cash outflows in this case, sorry, inflow. For the parent, it is future cash inflows. The only inflow he's going to get is the principal money at the end of the third year. And as far as the fair value for the subsidy is concerned, it is supposed to be the present value of the future cash outflow. So it will be the present value of the future cash outflow. Though the focus in this question is only on the books of the parent, so I am concentrating only in the books of H, but I've also correspondingly given you the treatment in the books of the subsidiary as well. Right? I hope we got the picture of the difference in transaction and the fair value in the books of the parent and the subsidiary. Let's work it out. So let's, I think, still work out the data as well. So question number 10. So first of all, let's only concentrate in the books of the parent company. That is the books of the holding company. So we will have investment In preference shares, debit, that would be at a fair value. And we will have a deemed equity investments. We'll have a deemed equity investments will be given a debit at a balancing figure. And the money which is paid gets a credit which is at a transaction value. So what is the transaction value? So can I say in this case, the preference share is worth, I guess, 500 lakhs. So
5
this is
crore.
to the tune of 500 lakhs. Yes, 5 crores. And let's calculate the fair value in this case. Can I say the fair value is the present value of the dividends, is not getting any dividends? Only
Not
the
getting.
present value of this 50 lakhs, 500 lakhs at the end of third year. So let's see the discounted value. So I think the present value factor at the end of third year is already given. I think it's a misprint. It's not 118, I guess. It's, I think, 7118, I think. This is a misprint. This is 7 actually. This is 0.7118.
Yeah, 0.7118.
Yes, so this is, he's going to get 500 lakhs at the end of third year into 0.7118. Let's see what is the fair value. I think it's 355.9 lakhs. So let's
Yes,
get the
sir.
balancing figure. So that's, I think, 144.1 lakh is the deemed equity investments in the books of the parent. Now the question rises, what will you do with this deemed equity investment in the books of accounts? Am I going to amortize this over a period of 3 years, or will it continue in the books of accounts?
Yeah, we need to amortize, sir.
Sorry?
Yeah, amortization will happen over a period of 3 years.
No. We will not do any amortization for this. This deemed equity investments will continue till, the preference shares are there. So no amortization of this will happen. This will continue. This is not an expense. This is not an expense. This is an asset. Unlike the staff cost, which was treated as a deferred expenditure indirectly, so it was being amortized over a period of time. So this is going to be an asset. Okay, so I think let's also make a ledger account for this investment in preference shares. Let's, I think, have a look on this as well. So we'll just make a ledger account for the first year at least, how this investment in preference shares would appear. So we record the entry investment in preference shares debit and bank gets a credit. So what was the fair value? I think 355.9. So this is 355.9. Are you going to record any finance income on this money?
No, sir. Dividend is not given.
No, I mean the finance income. We did a discounting, and when we did a discounting, there will definitely be a compounding. So we are definitely going to compound the interest at the benchmark rate, which is 12%. I may not be receiving anything, so there will be no entry on the credit side in terms of bank because there is no collection.
Yes, sir.
But
Debit
we'll
side will
still
be entry.
record the finance income. And I'm calling it as a finance income because this is not a dividend income. This is actually a financial asset in a debt investment. So that so-called dividend income which you're getting is supposed to be a finance income. So let's take a 12% finance income on this money. So 355.9, 12% would mean 42.708 is the finance income. So there will be no collections at the end of this year. So there is no collection. So we'll just take a balance CD as a balancing figure.
398.608.
Right. So this is 398.608
608.
lakhs. So can I say, if I just ask you a simple question, when you make this ledger account for the next 2 years as well, are you going to reach that 500 lakhs? Because now what you're doing, you're compounding at 12%. So are you going to reach that 500 lakhs, which is the redemption value at the end of the third year, correct?
Yes, sir. We will reach it.
Yes. So irrespective that there is no inflow in terms of any income or dividends which you're getting, but since we are considering the concept of unwinding, we took the present value of that principal discounted. Definitely it'll lead to compounding. So interest income gets recorded. I hope you can manage the ledger for the next 2 years to come. So two cases done. So we have dealt with a case of employer-employee relationship in which we said the difference is a prepaid staff cost that is being expensed over a period of life of the loan on a straight line basis. Second case we have done where there is a parent-subsidiary relationship, in which particular case it becomes a deemed equity investment, which is an asset and not an expense. So it continues in the books of accounts. Now let's have a look at a third case as well.
Sir, one question.
Yes,
See,
yes.
the question is that redeemable preference share. In case of irredeemable preference share, then the situation will be the related party transaction, equity.
Okay, you mean to say that there is no dividend as well as the principal is irredeemable?
Irredeemable. In that case, the holder and the issuer perspective, the equity investment, both sides.
Correct. Then it's
Then
an entire equity investment. In this
then
particular case, since it's a redeemable preference share, you can say it's a debt investment and a deemed equity investment. Otherwise, if you say it's irredeemable without any dividends, that means they've issued an equity instrument altogether.
yeah,
And
in
if they've
that
issued
case,
an equity instrument, then it's different.
yeah, then
Yes.
that case the Ind AS 27 will apply, not 109.
To the extent you establish that there is, yes, because if you're saying there is already a control and now you're saying that they've issued further equity shares to the parent company, yes, then the financial instrument standard will not apply. Correct.
Yes, sir.
Absolutely. Absolutely. Okay, let's have a look at the third case now. That is a customer and a supplier relationship. This was concession loan. Okay, now let's have a look at the question number 9, which is on the customer supplier relationship. And this is interesting because this will blend Ind AS 116. Yes, you heard me correct. This will blend Ind AS 116. It's a lease transaction along with Ind AS 109. It says M made a security deposit whose details are given, the start and the finishing date for a period of 5 years is given, and determine how the financial asset should be measured and briefly explain the measurement determined as such. Make the necessary entries for the security deposit in the first and the last year and assume the market rate for similar deposit is supposed to be 9%. That's again an examination question. Am I given anywhere the contracted rate of interest on this deposit? I don't see that there is any contracted interest rate given in this question, which means that it is an interest-free security deposit made to the lessor. So can I say in this particular case, the contracted rate is 0 and the market rate is 9? Certainly it indicates it's an off-market transaction. And if it is in off-market terms, we can clearly see the relationship of customer-supplier. In this case, the customer-supplier will be called as the lessor-lessee. Because if you're under the purview of the lease standard, the customer is called the lessee and the supplier is called the lessor. So it is a lessor-lessee situation. So let's see how do we account question 9. So let's have a look at the inputs in terms of question number 9. So this is a case where we can say it's a lessor-lessee relationship, or you call it as a customer-supplier relationship. So the question arises that we are looking at the accounting in the books of the lessee who gave a security deposit and for whom it becomes a financial asset. So we're going to put the entry security deposit gets a debit. Security deposit gets a debit, and this will be at a fair value. Can I say what will be the fair value in this particular case? Can I say the fair value will again be the present value of the future inflow, which is only the principal money of the deposit?
Yes, sir.
And the bank gets a credit. The bank will be given a credit at the transaction value. So let's see what was the transaction value.
20 lakhs.
20 lakhs. And there is discounting factor 6499. So this
6499.
is 20 lakhs transaction value, and this is the present value into 0.6499.
12 lakhs 99,800.
12,99,800, almost 13, I think, approximately. I'll just take it for convenience.
Okay, sir. 7
So
lakhs.
in this particular case, we're getting a balancing figure on this side. So what is the balancing figure? 7 lakh. So what are you going to call this difference as? When there is a lessee-lesser relationship, right of use asset.
Right.
This is also not an expense, but yes, a right of use asset is certainly depreciated over a period of time. So can I say this difference is going to be called as a right of use asset as per Ind AS 16? And this right of use asset will be depreciated as per Ind AS 116. And this will be spread over the way you depreciate the asset under Ind AS 116. So this right of use asset will be depreciated
For a year.
as per Ind AS 116. I'm not saying over 3 years. I have a reason for that. You know why I'm not saying 3 years? Because depreciation depends upon the fact whether the asset will revert back to the lessee or lessor or not. So I'm going a little safe on that end. So I'm not defining that particular path. So I'm just saying that yes, it'll be depreciated over a period of time, which will be decided as per Ind AS 116. So I think let's do one thing. Let's consider the life of the asset. The lease is for a period of 3 years. So let me make the two ledger accounts. Let me give you the security deposit for a period of 1 year and the right of use asset also. So let's see the two ledger accounts now. So one is the security deposit, which is the financial asset, and one is the right of use asset. Let's see it at least for a period of first year in this case. So we've got the security deposit. We've got the security deposit ledger, and we've got the right of use asset ledger. So let's, I think, first of all, take the entries in terms of the security deposit. I think it was 13 lakhs, I guess, security deposit.
Yes, sir. 13 lakhs.
Okay, that's wonderful indeed. And the right of use asset approximately we taken at 7 lakhs. And we've got a life, I think it was 3 years or 5 years, was it?
5 years, sir, I believe.
Okay, we'll just have a look. So I think in this case, it was 5 years. So if it is supposed to be 5 years, so let's first calculate the, okay, are you going to consider the finance income on the security deposit? I'm not getting any interest. But are you going to accrue the finance income at the rate of effective, the market rate of interest?
Yes, sir. We need to consider
Yes,
it.
undoubtedly, yes. So what was the market rate of interest in this case?
I think
Okay,
six.
I think we'll have to locate it back.
I think 6 or 9. I don't know. I'm not.
No, that's okay. So the
9%.
market rate of interest was 9%. So let's see the interest at the rate of 9% on 13 lakhs. That's 1,17,000. But we are not receiving anything further. So we just take the balance CD as a balancing figure, and that is 14,17,000 is the balancing figure. Can I say as we compound this security deposit, is it going to become 20 lakhs at the end of the 5th year? And then you
Yes, sir.
receive the 20 lakh money back? Yes.
Yes, sir.
So this accounting will of course continue. And as far as the right of use asset is concerned, we depreciate it over a period of 5 years. So let's assume a straight line depreciation. So I think it's 1,40,000 is the depreciation on the right of use asset. And we get the balance CD as a balancing figure. And this will also continue for a period of next 4 years to go. So I think this is going to be 5,60,000.
And the end of the 5th year, it will be zero. Right of use.
Of course, absolutely correct. So I think we've got a flair in terms of all the three permutation combinations. Let's create a small little mind map on this part as well. This was the special issue that if there is a difference in TV, transaction value and a fair value, how does the difference get accounted depending upon the type of relationship? Okay. So let's, I think, make a little summary chart on this as well. So I'm just concentrating on the third step, which I gave you, that what is the kind of relationship and what kind of entries is done. So let's look at a summary chart. And this is with reference to the transaction value versus the fair value differences to be accounted for.
Off market.
Yes. So when the transactions are at off market terms, rightly said. So when the transaction is at off market terms, how would the things take place? So we've got typically, you can say, three cases. Looking at the questions in the study mat and looking at the questions which are there. This list of relationship which I've given you is not exhaustive in nature. This is generally what is seen. So we've got, first of all, employer-employee relationship. We've got an employer-employee relationship. We've got a parent-subsidiary relationship. And we've got, you can say, customer, or let's call it as lessor-lessee relationship. So I'm looking at the entries from the point of view of the holder. Though in subsidiary, I also gave you the entry from the point of view of the issuer, but in the summary chart, I'm only focusing from the point of view of the holder. So what are the entries which the holder would do, who is basically calling it as a financial asset? So let's look at the summary entries at the inception, the entries which are done at the inception. So can I say in the books of the employer, the entry is loan gets a debit at what value?
Fair
Fair
value.
value. And the bank gets a credit at what value? Transaction value. And the difference in this particular case is the balancing figure, which is the staff cost.
Stop cost.
And what do you do with the staff cost? Amortize it on straight line over the period of the loan. So this staff cost is supposed to be amortized on straight line method over life of the loan. It is amortized on a straight line basis over the life of the loan. That's one typical case. Let's now look at the other one, the parent-subsidiary relationship in this case. Can I say the parent is going to first of all record the investment? So we're going to put the investment, and this investment again gets a debit at what value?
Future value.
Fair value.
Fair value.
And the bank gets a credit at a transaction value. And here again, we're going to take the difference as what?
Deemed equity.
That's right. We're going to get the balancing figure as a deemed equity investments. It is deemed equity investments. And are you going to amortize this deemed equity investments? No.
Yes, sir. No.
No. Will not.
No.
Yes means
Will not.
yes to the no, right? Okay. So not touched. This is not going to be touched in this case. This investment continues. Because this is an investment which you made, and this investment will continue. So nothing to be done in this case. Now comes the case of a lessor-lessee relationship. So can I say in this particular case, you put the entry security deposit gets a debit. And the security deposit gets a debit again at a fair value.
Fair value.
And the bank gets a credit again at a transaction value.
Difference.
And again, we get a balancing figure in this entry.
Right of use asset.
That's right. Because lessor-lessee relationship will lead to a right of use asset. And this gets the debit, right of use asset gets a debit. And what do you do with this right of use asset as well?
Yes, we will do the amortization over period of depreciation. SLM.
Depreciation will be taken as per 116.
116.
So this right of use asset is going to be depreciated. Is going to be depreciated as per Index 116. Lease term or whatever the parameters would apply. So just better to put it as 116. So this summarizes the special issues related to difference in transaction value, fair value. Trust me, the entire chain of what I'd given you is done. I'll just like to take you back on the chain of thoughts which I'd given you earlier in the earlier part of the class when I created a mind map. So let's, I think, connect the dots. Where is it gone? I think I made a mind map on this.
Sorry, you done observable and unobservable type also given employer like that.
No, I had also created a mind map in terms of things. Here it goes. This one. So where do we stand is now the evaluation out here. So you can see that the chain of thoughts, all this is done, except for this adversarial issue, everything is done. We've covered the accounting from the issuer point of view, financial liability, equity instruments, CFI. We've also done the accounting from the holder's point of view, debt equity investments. We've tackled the special issue of fair value and transaction value. So all this area is done. So now we need to touch upon the three additional issues. One is on the derecognition, one is on the impairment, and one is on the hedge accounting. So what do you want me to start right now? Though we don't have much time, I guess, but maybe we can give you a little introduction. So what do you want to start with? Derecognition?
So you had also left one financial liability part chart. You said you'll make it later.
I need a
109.
financial liability chart. I've already done that. This is financial liability chart.
Okay.
I've done a lot of charts today. Actually, I've done a financial asset chart. I've done a financial liability chart. I've done a TC chart. And I've also made another chart on the transaction fair value. 4 charts I've done. Financial asset, financial liability, TC, including processing fee, and the summary of transaction and the fair value differences as well. Yes, I think somebody raised his hand. Yes, please go ahead.
Sir, we discussed about the special case like transaction cost, processing fees, and finally off-market situation. Is there any additional special issues there in with respect to India's in addition to this?
No, not from the examination point of view. Because when you're considering the aspects of accounting, financial asset, financial liabilities, I would say typically there will be 3 issues. The concept of TC, which we have covered both on asset liability, the concept of processing fee, which we have covered, and the concept of transaction and fair value differences. Other than this, there is nothing else. Yes, there is one particular question which is there. If you want, we can do it in the next session because that's going to take a little time. And that is with reference to the same case where there is a transaction and a fair value difference, but there is a prepayment of a loan which is done by the employee. So there is one special agenda. I remember that this has also come in the exams twice. I think I put a question also on that area. I'll just show you that particular area. So this is one area which I've not touched. Yes, this is it. I think I just missed this particular agenda. This is question 11 actually. I think I've just taken it down. So if you want, we can do that particular agenda where a concession loan is given to the employee and you identify the difference in transaction value at time 0. You put that prepaid staff cost in a separate ledger. But then during the tenure of the loan, there is a prepayment of the loan which is done by the employee. So what happens to the treatment of the prepayment amount? Because that prepayment amount is split between 2 elements, what is paid towards the loan and what is paid towards the prepaid staff cost. I think if you want that, we could, maybe cover that in the next session because that will take some time. We can't do it in the next 5-7 minutes. So you want me to cover that issue?
Yes, I will cover it, sir.
Okay. So we'll do that particular area. So I think apart from that, there is no other special agenda. That is only one special agenda that if there is a prepayment during the tenure of the loan, what happens to that particular treatment? And other than that, I think we're just left with three issues. So what we'll do in tomorrow's session, not tomorrow's, I mean on the day after Wednesday session, we are going to first of all pick up the case of a prepayment. That if there is a prepayment in terms of the loan, how do we tackle that? Then we'll consider the special issues on derecognitions and go on to the concept of impairment and hedging, because we've got two more sessions on that particular area. Yeah, I think ma'am is also there. I think ma'am.
Yes, sir. Good morning.
Good morning, ma'am.
Good morning. So when you end up the session, just let me know. I'll give 5 minutes. I'll take you 5 minutes at the end.
Sure, ma'am, you can, ma'am, because I've just finished with the topic, ma'am.
Okay. So students, so you'll be winding up now?
Yes, ma'am.
Okay. So by that, students, hope you are filling your feedback form, and today is your open house session from your 4 to 5. No? So 3 to 4, sorry, 3 to 4, we'll be having an open house session for your financial reporting paper. So students, those who are having doubt in your earlier sessions, you can come to us and you can raise your doubts, and I'll prefer if you can mail your queries beforehand so that it will be a smooth transition and we'll be able to reply without any unnecessary involvement of time. Okay, so we would like you all to take that benefit of open house session, and hope you're also filling the feedback form, and those who are and all are in the WhatsApp group for students which has been created by Board of Studies. Okay, any other query students want to raise to me, they can ask me right now, otherwise we'll wind up the session.
And can we make it a specific for a particular subject, like a particular chapter for this day and particular chapter for another day, because so that we can prepare our doubts according to that?
It's a good idea. It's good idea. We'll try to do it. Right now, it is open for all the topics. When you can do one thing, if you're having any doubts in a particular chapter, you can mail me. I'll just try to just work out with that, and I'll be able to respond you during your open house session. So my mail ID is shilpa@ici.in. You just mail me your query, any technical query, general query, whatever you have. I'll be responding you at that time. Okay.
Ma'am, what is the WhatsApp group number?
You're not having that word. You're not in the WhatsApp group.
No.
Just now, we'll give you the link. You join it through that link. Na? Huh? Acha, Geeta Kalidas, na? You are asking this regarding this WhatsApp group?
Yeah, ma'am. Yeah, ma'am.
You
I
do
am
one
asking.
thing, Geeta. Just put your mobile number on this chat box direct to me. I'll add you, na? We can do that, na? कल भेजेंगे अभी number ले लेते हैं है ना. You just give me your number on this WhatsApp group for this chat box. We'll add you. Okay.
Okay, ma'am. Okay, thank you.
Okay. Any other student who is not there in the WhatsApp group, they can also put their number on this chat box direct to me. I am from right now. I have joined through BOS ICI co-host. So you can just put your number on this chat box, and I will add you. Okay. Any other person, and we request all of you to fill the feedback form session wise.
Okay, ma'am.
Okay, and we request to put, in case you are joining this open house session, put your query to me at shilpa@ici.in. We'll be taking that care of that those queries during the open house session. Any general query, technical query, whatever. I would prefer if you give me your query in advance, because it will help me to give you a better guidance on this. Na?
Okay, ma'am.
Okay.
Yes, ma'am.
So Geeta, I did not get your number.
I have sent, ma'am, in this chat box.
No, I am not receiving it.
Ashok Tech Support Ashok.
No. That is not BOS ICI. Put me your number on BOS ICI.
I have to go in another that.
Ashok ji, you are having that number. You can share that with us, na? In case Geeta is not able to do that, you got your number, na? You got her number.
अशोक जी आपके पास लिंक है?
Ma'am, sometimes we get difficulty in identifying some of the indices together. I mean, common points and uncommon points. If we can have one chart for that.
No, sorry, I did not get you. What exactly you want to know?
Some indices have some common points, and some treatments are different in those indices. There are some distinguishing features also between those indices.
Every index is
That,
dedicated
that
to a particular topic, beta.
that is true, ma'am. But there are some similarities also in terms of treatment, like uh, unwinding or impairment in some indices, and some treatments are distinctly different in respect of those things in some indices.
So in that case, now we would like you to refer the Saransh, which we have uploaded separately. It's a separate publication which is given there. And for every standard, we have summarized it, and for every aspect, we have given the chart or table. In a pictorial
Okay.
form, we have explained that. That from there, you can refer it. But if you want, like I understood, you want to say impairment of financial instruments, impairment of assets, impairment of intangible. That's kind of you're asking something, na?
Yes, yes, ma'am. Some areas are similar, and some treatments are very different. So for those,
See, right now we have not come out with such type of work, but this is a good suggestion. We'll try to work on this and we'll come with. Right now, we have. I will
it,
just suggest that refer
it
Saransh. Okay, Saransh.
yeah,
Sorry,
it will help us in, sometimes in MCQs and these kind of questions come, and then we have to identify
I
those.
got
And
your point. I got your point. We'll definitely work on this. I'm just noting
thank
it
you,
down that this
thank you,
suggestion
ma'am.
we'll try to work on this. Okay. Any other query, beta? Geeta, we have noted your number. Hope we'll join you soon in that WhatsApp group.
Okay, ma'am. Thank you.
And please fill the feedback form, beta.
Okay, ma'am.
Okay. So students, if you don't have any other query, we can wind up the session. So thank you,
Thank
sir.
you.
Thanks for your guidance
Thank you, ma'am.
and
Thank
hope
you so much.
students are enjoying your session. So this is a revisionary classes. Hope you're taking good number of illustrations for solving the
Yes,
exam-oriented classes, sir.
absolutely, ma'am.
Okay. Bye, sir.
Thank you, ma'am.
Bye,
Thank you, ma'am.
Thank
students.
you, all of
Bye,
you.
Thank you,
See
sir.
everyone.
you in the next
Thank you
session.
very much, sir, for your
Thank you,
time.
sir. Thank you, sir. Thank you, ma'am.
Thank you.
Thank
Thank
you.
you. Bye bye.
Bye.